Welcome to Options Brew TV. I've got a great guest today, David Modell. Did I say that right, David? The last name, I probably messed that up.
You did. Good job, David Modell.
Modell, I got it right.
Yep.
Awesome. And
Look at
Steven
you,
Samararo. I know. Steven's one of our guys. He's on the trade of your side. David has his own, I don't know, maybe a few companies, if I'm not saying Wealth Global, Crush the Street, Investor Place, right? Are these all things you're associated with?
I am. I've written for crushthestreet.com, investorplace.com, Market Realist, Stock Pence, tipranks.com, and others. And I'm also an analyst with portfoliowealthglobal.com. So I wear many hats.
Oh my God. So you're an educator, a writer, a trader, all of the above, right?
Yeah, it's a lot of plates to spin, a lot to juggle, but you know, it's funny. A lot of people can do options trading well, but that doesn't mean that they can educate other people in this. Doesn't mean they can teach it.
Right.
So you really have to have two separate skills. I know that you guys have it, and hopefully I have it as well. I plan to share it with as many people as possible today. So yeah, so let's get started.
Yeah, that's great. So, and then before we get started, we're going to put that in the video, your sites. So if there's one that's more specific than the others, let us know. We'll get that in the finished product.
Cool.
And then let me introduce Steven. Steven's with Tradier. He's our resident mathematician, physicist, data expert, coder, all of the above. So he knows everything about APIs and about, and I wouldn't say trading yet. He's too young to know enough about trading.
I'm Lex's prodigy. He's going to teach me everything about trading.
There you go. So that's what my business was trading. We were floor brokers, or floor market makers, I should say. So
yep.
No longer. We're dinosaurs. We're in the museum now. So, all right, David, very good. So what are you going to talk about today? Tell us a little bit about, give us something in terms of how you look at the world here relative to trading.
Sure. Well, I have a master's degree in education, and I love to help people and teach them. And a lot of people contact me through my YouTube channel about not just stock trading, gold and silver, all that stuff, but also options. They want to get into it, especially with the fact that it's oftentimes commission free or low commission nowadays. Since they brought the commissions down, that has democratized trading, including options trading. But a lot of people, they don't know how to do it properly, and they can lose money very quickly in options, even faster than with stocks most of the time. So I have a safety first approach, and I like to have a high probability approach as well. And how I make it high probability is whenever I'm trading options, in almost every case, there are always exceptions, in almost every trade, I try to be an options seller in some capacity. Yes, I can also buy options too. That's fine. But I want to be a net seller, meaning I'm doing more selling than buying on a notional basis or on a dollar basis, either way.
Sure. So it's safe to say you're trying to take advantage of theta, right? And some of that decay, that natural decay that option premiums do. That's just their nature, right? They decay.
Options are deteriorating instruments, is what they are. They fall apart. They melt like ice cubes. That's how I explain it to beginners. I like a lot of analogies to help them understand. So imagine an ice cube. Does an ice cube immediately melt, just turn into a puddle of water if it's a brand new fresh ice cube you just took out of the tray, out of the freezer? No, it starts to melt slowly at first. You almost don't even notice it. You see a little bit of, melting happen. But then as time progresses, the melting becomes more severe to where it doesn't even resemble an ice cube anymore. It's becoming a puddle quickly. And so I'm sure, hopefully you've shown, or the people in your audience have seen, that horrendous looking theta decay curve, right? That chart that shows it, when an option, all else being equal, assuming, which is not realistic, that the price of the stock or ETF is just going sideways, right? Assuming that volatility doesn't change, assuming that everything else in the Black-Scholes, formula isn't changing, all else being equal, if an option has, let's say, 3 to 6 months on it, well, the theta decay isn't that bad, okay? So if you're gonna buy option premium, I recommend people go 3 to 6 months out as a buyer until expiration, because that part of the curve is kind of, well, it's down a little bit. It's not perfectly horizontal, but it's kind of down, but not too bad, right? Why not buy a year's worth? Why not buy 1 to 3 years, a leap option, as they call it, right?
Sure.
Well, those become pricey. Those become expensive for most people. I mean, hey, if you can afford to buy a leap option, go for it. Also, you have to have a certain amount of patience because leaps are like icebergs. They don't move that fast.
Right.
That's not an ice cube melting. That's an iceberg you're waiting to melt. Okay.
Right.
So yeah,
Those are great analogies, by the way. I like it. And I'm talking
you.
pictures too. I love it.
Yeah. Very cool. So if I'm going to be a buyer, I'm going 3 to 6 months out. That way, at least you get a couple of months there, like months, 6 and 5 and 4, where the theta decay doesn't hurt you that badly. But again, I'm also a buyer. And so if I'm going to, let's say I believe that Apple stock or whatever, it is not going to go down much. Okay. Notice I didn't even say it has to go up. I just don't want it to go down much.
Right.
Maybe I'll buy a call option on Apple stock. And you can show this on you can share your screen.
You want me to share my screen now, David?
There it is. There it is. Okay. And yeah, so on your trading platform, we're looking at Apple stock there. And let's say, what is Apple trading at right now? 145 and change, almost 146. Fine.
Yep.
Let's say I believe that Apple stock, again, I'm not even going to assume, I'm not going to have a directional assumption. Let's say I believe it's going to not go down so much, right?
Okay.
So I might buy an in the money call option,
Okay,
right? This is one way to do it with debit spreads, right?
Okay. What month would you choose in this example?
So 3 to 6 months out. You know what? I'm going to let you choose it. I'm going to pretend you're a student, even though.
Perfect. So 3 months, it sounds like about 90 days. Is that right?
That's about right. Now
so
that's
100, which is November. Is that okay?
That's fine. Between 3 and 6 months is what I recommend. Now, if you go closer to 3 months, you're taking there's a little bit more risk. A little bit more possible fast reward though. You're looking for the little bit quicker profits, but a little bit more risk, right?
Got it.
You're on that steep or starting to get steep end of that theta decay curve, right?
Okay.
If you go closer to 6 months, you're being steady Eddie, right? You're being a little safer, but you're not going to make those quick profits.
Understood.
Right? So I don't tell people go closer to 6 months or 3 months. It's your decision to make what kind of risk reward profile you want.
Okay.
Now I'm going to buy
100 days. How's that sound?
Sounds great. You're closer to 33 months and 6 months, but that's cool. That's your decision to make.
Yep.
All right.
Okay.
Now let's pick one that's, let's say a couple strikes in the money. Let's say 2 strikes in the money.
Okay. So for me, that would be the 135s in this example. So the blue line on this screen is the at the money. So the at the money is 2 above that. The 145 is the at the money.
Yep.
And 2 beneath it would be the 135 strike. So I boxed that out over to the left. Calls are on the left. I think that's what we're going to do.
That's reasonable. Okay. Now, again, we're allowing some breathing room because even if your directional assumption that it might go up is right, it's still going to wiggle and wobble around, isn't it? Okay.
Yep.
So now what would that cost by itself if I were to just buy a 100 days out, approximately 135 strike call on Apple, which is now trading at around 145?
It's $14.57 as a midpoint. I'm going to make it 60 cents because I hate the pennies. So $14.60.
Right. Yeah. Okay, cool. So not everybody can afford that. First of all, $1,460 plus any commissions, fees, whatever. Okay. So it's a little pricey, but some people can't afford it. Cool.
Let's say we can't afford it. Let's do it.
No, don't you dare, because we're also going to be a seller.
Oh, beautiful.
You always want to be a seller as well, because I'm glad you bought in the money, because those have less severe theta decay than at the money or worse yet, out of the money options.
Right. Those dastardly out of the money things.
Out of the money options look so enticing, don't they? Because they can go up like crazy if you're right directionally immediately.
Right. Right. We call them lotto tickets. How do you win at the lottery? Not very often.
Yes. So to offset the cost and to increase my likelihood of profiting, I'm going to buy, well, it depends how much I want to spend on this.
Okay.
Let's sell the 120. Let's buy, we're buying the 135. Let's sell the 140.
Okay. So we're going to sell the 140 in the same month, right?
Correct. Yep.
Okay. So I'm going to sell the 140. So I've got a $5 call spread. It's going to be a debit spread. It's now $3.47. I'm going to make that $3.50 because again, I hate the pennies.
Right.
And I'm going to make it a 25 lot because I'm huge. Let's do it.
There you go. Okay. So we're risking 350 to make 150. How did I arrive at that? The size of the spread is $5.
Right.
You're coughing up 350, but you're trying to turn that 350 into $5, therefore making 150. Okay.
Mm-hmm.
Now that may not sound like a great risk to reward ratio.
Mm-hmm.
No problem. Okay. We can adjust that. But what's the likelihood that Apple stock, which represents a great company, and we're only doing this on fantastic, highly profitable companies with high liquidity, by the way. Okay. The volume on these options is going to be terrific because it's Apple. Okay.
Mm-hmm.
You're not going to have some dollar wide bid-ask spread probably, or something like that. It's going to be, 10 cents, 15 cents is what I'm seeing up there at most. All right.
Yep.
So I like the prospects on that. Do I like it a lot? No, because when would I do this? Not today, because look at Apple, up a little bit, up or flat. Now, what if I put this on right after Apple had, let's say, 5 red daily candles in a row, 5 bad red days in a row?
Mm-hmm.
That risk to reward ratio would be much better. Okay. I wouldn't be risking 350 to make 150. I would be risking, let's say, 250 to make 250. That's called risk 1 to make 1.
Right.
Okay.
Mm-hmm. We like that.
You only get that risk 1 to make 1 or something close to it when Apple stock or whatever it is, whatever the underlying asset is, after it went down a lot. Okay.
Okay.
Right now, you're going to get, it's still not bad. I'd still do it. Okay. Why? Because it's Apple, for goodness sake. Okay. It's probably in a few months' time, it's probably going to be higher than it is now. Probably. Okay.
Okay.
Actually, you don't even need it to go up, though, as long as it stays above what was it? 140, the one that you sold. Okay. Yep. As long as it stays, so it could actually go down a little bit, or it could float sideways. Cool.
Sure.
Stocks are trending 30% of the time on average.
Mm-hmm.
They're ranging, meaning going sideways-ish, chopping around sideways, 70% of the time.
Okay.
So why not take advantage of these range-bound stocks? And have you noticed that Apple lately has been very range-bound? Surprise, surprise, right? It's been just kind of choppy sideways. It's been between 135 and 145, or 150 was the all-time high, exactly 150, oddly enough. Mm-hmm. Conspiracy theory, I don't know, but it hit exactly 150. That's the top of the range. So if you think it's going to continue to go sideways, which 70% of the time these stocks do on average, not every stock, if you pick some crazy volatile stock or some VIX product, it won't do that. But something like Apple, mostly ranging. Why not take advantage of that? If you just buy the stock, you need it to go up if you want to profit. With this one, it can go sideways, you win. It can go down a little bit, you win. Yep. It goes up, cool. That's just as good as sideways or going down a little bit. As long as the darn thing stays above 140, and I shouldn't even say that. It doesn't even have, it can go below 140 for a while and then come back up. Cool. Because every day that theta is hurting the option that you sold more than the option that you bought.
Mm-hmm. Right. Right. No, absolutely right. So if you look at it, the other side of this is the put, right? So that's about the premium less some carry in the underlying for that 135. This is the premium in the 140 call, roughly, right? Because all that has to be equated correctly. So you're going to lose $3.65, but you're going to make $5.15, which is a bigger number. So to David's point, this one has a lot more to lose juice on than the one beneath it. It has much more premium or extrinsic value, right?
Sure.
So
absolutely.
Awesome.
So that's one way to do it. Now, a friend of mine, David Lincoln, who used to be on the trading floor like you were, once told me that for every debit spread, there's an equivalent credit spread, right?
Right.
You might have to construct it differently, like with you could have a credit put spread that's pretty much the equivalent of this. It's pretty much going to be the same risk to reward, right? Sure. You could do that. So you could set up you could sell a put that's now
this one, right?
Yeah, you would sell a put that's below the current price, out of the money, right? And then you'd buy a protective put $5 below that, which it looks like you're doing,
that's
right? Yep. And again, you're probably risking about the same thing. Okay.
That's right. So let's look at it real quick. I'll show it to you. So this spread is $1.50 midpoint. That's the credit. So again, back to David's point, anything above 140, we're going to collect that $150 per spread, right? Remember in the spread we just did, the debit spread, it was $350. The most we can make is $150. Same deal, just a different kind of dynamic with selling the put spread.
Right. So
same result.
Yep. People say, Dave, should I sell a credit put spread or should I buy a debit call spread? That's like asking, 6 of one, half a dozen of the other, right?
Yep.
Either way, it's just a preference thing. Do you want to get paid now? That's the credit spread.
Yep.
And maybe lose more money later, or do you want to lose money now and hopefully make that and more back later, right?
Yep.
Either way is totally cool. But either way, you're being a salesperson. That's in some capacity, in some way, shape, or form. Right. Another way to do it is I hate this term because it's disparaging a little bit in these PC times, but the poor man's covered call. Love this one.
Okay. Well, how are we setting that one up?
Sure. Let's say you still think that Apple is gonna notice. I'm not even gonna say go up, just not go down much, right? Okay. So, and let's say you could afford to buy 100 shares. Okay. So you buy 100 shares. So you now are the proud owner of $14,586 worth of Apple stock. Cool. Okay. Now, since what's cool about that is, there's no theta decay, right? Okay. You don't have to worry about that. The delta is 100, right? So it moves, right?
Sure.
But you want to be a seller and you're going to say, I'm going to listen to this Dave guy. He knows a thing or two, maybe, hopefully. Okay. So I want to be a seller in some capacity. Okay. Well, how about, let's say every week, you can rent out your shares like a landlord, right? You can rent out your shares every week by selling a covered call. And I'm going to sell at the money because I don't mind losing my 100 shares.
Okay.
I could always buy them again.
Right. So what I'm going to do is I put my 100 shares in there. Okay. Yep. And I'm going to the front weekly. Is that what I'm doing?
Correct. Now, since there are only 2 days left, I'll give you permission to go the next week out.
Okay, let's go to the 9-day one.
Right.
A little bit more juice in this one. Yeah. So this one has the 146 as at the money. And remember, as you go out in time, so for viewers, you don't get all the $1 strikes. At some point they stop and they become $5 strikes differences. So since we're so close to expiration, you will get these $1 strikes. So now all of a sudden the at the money is 146.
Yeah, you don't want to do the 145 because that's in the money, and now you're going to lose 86 cents basically. You know what I mean? So yeah, go 146. So you may have to go a little bit out the money. It's not that's okay. All right. And so what would you collect from that if you were to sell that? I know the options market is closed, but theoretically,
it's $1.60-ish, let's call it.
Not too bad.
Not too bad.
Yeah, that's per share, by the way.
That's right.
Okay. Now what's the worst that could happen? Well, the worst that could happen is Apple stock tanks. Okay. Just for whatever reason, people decide they're not going to buy iPhones. They're not going to pay $1,200 for iPhones anymore. Right. Okay. So that would have happened whether you sold that covered call or not. At least you got paid $1.60 to help defray or offset that loss. Right.
Yeah, here's what it looks like. It just looks like a big short put. That's all it is.
Pretty much.
That's all. Okay.
Okay. But this is but imagine a short put you could put on week after week after week.
That's right. Exactly.
Okay.
Right.
So let's say the stock goes down, or let's say it stays the same, right? Then your shares don't get called away and you just collected free money. You sold somebody a contract for nothing, right? Cool. Okay. Then what do? Rinse and repeat. Do it again next week. Whatever the at the money is, do it again and do it again and do it again. And you're collecting money and collecting money. And the next thing you know, you net only paid $130 for Apple stock or 120, whatever. Absolutely. Right. I'm exaggerating.
Let me ask you a question, David. Yeah. Do you ever toss in the long put and get that collar on so that you limit your downside, even though it's a small price? You eat some of that credit up, but you keep doing that little process. Is that ever a strategy, do you think?
What he's referring to for the audience is sometimes you could take that premium you collected from a covered call and buy a protective put underneath the strike, underneath the current price of the stock. So if it tanks,
Yep.
you're covered to a certain extent. It doesn't get rid of your entire loss, probably,
Right.
but
Yeah, so it looks a little different. I'll just show the viewers what
and that's a
different-
collar.
Yeah. So this kind of collar, you can see where we don't have infinity to zero down here anymore. We kind of stop
Yeah.
out at a price. That's the only difference.
You're going to give up most or all of the purpose. You're going to give up most or all of that premium you collected
So
because
we don't
puts
like
are-
that, right?
Yeah, puts are expensive.
Oh, yeah, I got rid of it.
Puts have a tendency to be more equidistant from the current stock price.
Yep.
Puts tend to be more expensive than calls.
Yep.
So you're not going to get much protection. It's only for 5 days or something. What the heck kind of protection is that anyway?
Right.
No, not worth it. Not worth it.
Okay.
What about if because Apple typically has put skew, but what if it has call skew? Wouldn't that be favorable?
The call values are higher than out of the money put values.
Terrific. Then you collect a whole bunch. Oh, I see. Is it worth buying the protective put then? I don't want to cough up my gains because the idea is to do this week after week after week, reducing that cost basis, you're not doing much cost basis reducing. Yeah, you get that little bit of protection, but it's not much. It's a few days of protection at a time, and you're trading scared. You shouldn't be trading scared. You should be, you should have researched the heck out of Apple as a company. Make sure they're not a chump company, but a good company that goes up over time, that's massively profitable, and that has super liquid options and stocks.
Love it.
Do you think there's a difference between trading scared or trading hedged?
In this case, the hedge is that you researched the heck out of Apple.
Yeah, I agree with that.
Okay.
Yeah, that's a good point.
Yeah.
So David, let me ask another question too. So as time goes on, we only have 9 days in the life of this option. Okay.
Right.
As time goes on, when do we take this one off and roll it out another weekly? So we don't want to let this go to the last penny. That seems kind of silly, right? There's nothing left in it.
Well, there wasn't that much.
Do you have a rule of thumb when you roll this?
I would just do it. Some people do it on Thursdays. I would just do it on Friday at 15 minutes before the market closes.
Oh, wow. So you let it go to the
Yeah,
the
I want to collect that whole thing pretty much.
Got it. Okay.
There's not much there. I don't want 75% of $1.60. I want all of it. It's not that much time. You can wait.
Right. Okay.
Now we didn't talk about the other possibility, which is your shares get called away.
Yep.
Okay. You still got the premium. Okay. So you didn't gain anything from the stock price movement. Whoop-de-doo. You're collecting week after week after week. Okay. You still won. All right.
True.
The worst case scenario is the stock goes down, but you're still glad you sold that covered call. And so why is it called the poor man's, I'm sorry, that's just regular covered calls. Now, the poor man's covered call, let's say you can't afford 100 shares because that's $14,000 plus.
Sure.
What you can do is instead buy a leap 1 to 3 years Apple call option.
Okay. Let's see what that looks like. Hold on. Let me get rid of this.
Same strike price.
Okay. So we're going to do what strike price we're going to do way out there?
Let's say at the money.
Okay.
Same as whatever you're going to sell.
Okay. So let's do a year-ish. How's that sound? Like about 310 days. Is that about a year-ish?
That's close enough.
Close enough. Okay. Let's do that. It's June, but not quite.
We're not going to love the bid-ask spreads, but at least it's Apple, so it's better than most stocks.
Not that bad.
Yeah, not that bad.
Away, it's 20 cents wide. I love it.
It's actually not bad.
That one in the middle. That's 15.55.
Yep.
The at the money, June of 2022 call option.
Yep. You just reduced your expenditure from $14,500 to $1,550 or something.
Yep. Perfect.
I mean, that's why they call it the poor man's covered call. You still can't be poor. That's a lot of money, but you could be relatively poor.
Right. So we're going to come back up to our 9-day and throw on the short side, right? Are we doing it right at the money again?
Yeah. At the money. Okay.
Perfect.
And so you got that leap. And so if worse comes to worse, okay, so you're going to sell it, right?
Yep.
Let's say Apple, if it goes down, you're glad you sold that covered it's not technically a covered call, but you're glad you sold that call because you're collecting money. Okay, if Apple goes sideways like it often does, you're glad you got rid of it. Right. Now, let's say Apple shoots up that in the next however many days, 9 days, 5 days, whatever. Okay. and now you get assigned. Oh no, right? Where are you going to get those 100 shares? Where are you going to come up with it? Remember, you have a leap call option to your name.
Right. Yep.
That's where you get it from. Somebody assigned you, you go assign somebody, and it all evens out, and your broker's not nervous anymore.
Right. Or, yeah. And then you're into a synthetic put if that happens, and then you could actually flip the position out too if you had to, right?
You could
and sell that call out.
Sure, but that's, again, I'm a seller in some capacity at almost all times. Now, people sometimes say, Dave, is there ever time that you're buying, you're just buying options? Maybe if it's a leap option, like 3 years out. Okay. I don't feel like selling those calls every week or something. I probably will, but let's say you want to keep it simple. Maybe I have I coach people. Maybe I have a student or a client who just wants to set it and forget it. Okay. Then I say, all right, you can buy the leap option and don't look at it. Maybe look at it a couple times a year, right? That kind of thing. All right. That could be sensible. All right. But even then I tell them go in the money, because I want it to behave almost like, I want the delta to be close to 100%. I want to behave like a stock almost.
Yeah, absolutely. Right.
Yep.
That's great.
Yep.
Very cool. Now, do you do a lot of iron condor kind of things, a call on a put spread, selling a call spread, selling a put spread at all, or not so much?
I have a video on that about iron condors. Actually, can I show my channel real quick?
Yeah, let's do it. Let me unshare here for you.
Sure.
Okay, which I just did. And
cool.
Go ahead and share.
All right. I'm going to share a portion of my screen. Hopefully people can see.
I can see it. Yep.
All right. There I am, my ugly mug, David Modell. I want people to visit my YouTube channel. It costs you nothing to go in the search box and type in David Modell. There it is. Okay.
Got it.
And Moadel. And I've got over, gosh, I think 800 now videos you can check out for free. And some of them, none of them have my face in them, right? Or very few. A few of them have my face, but most of them have much more attractive people than me in it. So you can look forward to that. Okay.
I love it. And we're gonna learn all about options. And it looks like you do some charting.
Sure, charting, chart patterns, but also look at that fat option premium. Is fat an offensive word nowadays? I don't know, but I want to get paid a fat option premium. And so I like to help people do that. And so I give out my picks, which are just picks. They're, you got to make your own decisions. I'm not a licensed or registered investment advisor by any means. Make your own decisions, but I'll give out some ideas that I have, and you can do your own research after that. So please check out my channel by all means. But you asked about iron condors.
Yes.
So I'll stop sharing my screen now so we can go back to your thing.
Yep.
So there we go. Stop share.
Yep.
So iron condors, a stock is either up too much, either went up too much or down too much. It can't have both. It can't be both situations at the same time.
Right.
So the problem with an iron condor, first of all, I'm not going to sell or do anything with options unless a stock or ETF went up too fast, too much, or down too fast, too much.
Got it.
What the heck are you going to do when it's just drifting sideways, except maybe a buy a calendar spread? That could work.
Sure.
But but if you're thinking iron condor, you're thinking you're a net buyer at first, right? You're not thinking calendar spreads. So so if a stock goes, let's say, down too much, and it's still again, you did your research. Apple's or whatever, Microsoft, Coca-Cola is still a great company. You determined through your research, thorough research, you decide the company is not really in trouble. It's an overreaction. Okay. Like when, what's his name? Steve Jobs passed away and Apple stock tanked. Do you remember that one?
Yeah.
I said, this is an opportunity. This is nonsense.
I agree with that.
The company will be just fine. I was sad that he passed away like everybody else.
Right.
But it's a great, he picked, look, Steve Jobs is not going to pick a moron to run his company. He picked Tim Cook, who knows a thing or two. Okay. Right. So I knew, well, you don't know 100%, but I was convinced that it would either come right back up, which it did, or at least it wouldn't go down much more. Okay.
Right.
So, at a time like that, when there's an overreaction to one side or the other, you sell something, let's say a credit spread in that direction. Okay. If something goes down irrationally too much, you sell a credit put spread. Okay. You sell a put and then buy a put underneath that in terms of strike price, right?
Yep.
Betting that, maybe it'll go down more, but not too much, right?
Sure.
You could be wrong, but
Well,
if it's
yeah, I did that in Amazon. Amazon had that big 300-point up day, and I read the news and I said, this is a little bit overdone. So I sold the 4,000 4150 call spread.
Yep. Yeah. You
That's
sell
a big
call.
gap.
Yeah, I know, but you sell a call above if you think it went up too much, and then buy a protective call above that and strike price.
That's what I did, and and it has produced just beautiful, flowers in that trade. Just fantastic.
Another thing about that is, if there's some large movement in either direction, the options are going to be more expensive, and with that higher IV. There's greater theta, so there's just more of a reason to sell.
Yeah, that's a good point.
In that direction,
it'll decay more quickly.
Yep.
Yeah,
great point. But I only sell in that direction because if Amazon shoots up a lot, what the heck am I going to get paid? What's the risk reward going to be on a put spread?
Right.
You're going to get ripped off. You're not going to get much bang for your buck. Right. If something goes down too much, how much are you really? You're going to get paid peanuts.
Right.
For selling a call spread above it. Okay. So it's very rare. There are always exceptions because all of my YouTube followers, they're all attorneys apparently, and they all find exceptions. I object. Okay. You found the exception. You caught me. Okay. All right. So they're always exceptions.
They're all experts.
They're all experts all of a sudden because they found some point where I put on an iron condor all at once. You caught me. Okay. It's rare. It's rare because something doesn't go up too much or down too much at the same time, but I might leg into an iron condor. What if something like Amazon goes up too much? Yeah. You sell a call spread and then it turns around, goes down too much. Then you could sell a put spread, thereby legging in. Even then I might not do it because if something went up too much, you sell the call spread above. Now it goes down too much. I'm probably not going to hold on to that call spread.
You're going to take it off.
I'm probably going to sell it.
Yeah.
Or unload it, I should say.
Yeah.
Buy it back is what I meant.
Buy it back. Yep. Absolutely.
So even then, I'm probably not going to put on an iron condor.
There's probably something to be said for putting money in the bank when you're right. Again, you don't want to over trade it and take small winners and let yourself have large losers. I get that concept, but
pigs get slaughtered, right? You got bears. And pigs get slaughtered, greed kills, say however whatever cliche you want. Okay. So iron condors are not something I do very often, to be honest.
Okay.
I go in the direction of the overreaction.
Sure.
And honestly, I sell a lot more put spreads than call spreads because this darned market keeps going up.
Yeah, right. Exactly. No, that's a good point. Let me pile on for a second and just kind of emphasize your point. So David's point is that you have to learn how to sell options intelligently. You didn't say that, but you mean it because that's how you're speaking. And I can tell you personal experience. I didn't start making money 100 years ago when I first started trading until I learned how to sell options. And I'm serious about that. I was taught to buy options. I lost. And the only time it turned around is when I learned how to sell options intelligently. What I mean by that is, and David just went over a lot of this, is, we're not advocating being long one option, short seven, and exposing yourself to infinite losses. We're not saying that, okay? But David's figured out a way to be crafty about selling options. I didn't figure out how to make money until I learned this process. Number two, what do insurance companies do? They sell you premium, okay? They are premium sellers, insurance companies. Warren Buffett is the biggest premium seller in the world, and he's one of the richest guys in the world because he says, hey, you need car insurance because if your car crashes, you need to buy it from me and I'm willing to sell it to you. And he's intelligent about how he sells it because he's got a whole gamut of premium that he's selling and not everyone's going to call him all at once, right? It's an actuary table that he has figured out. And it's very similar to the options board. It really is. You don't want to sell cheap premium, right? When the hurricane's right off the shore, you don't want to sell hurricane insurance for $10. You might sell it for 15 million, but you don't want to sell it for $10. So you got to be smart about that, right?
Yep. Think of yourself.
A lot of people my age, they're always buying options, right? And some people don't even know you could actually sell an option. I've literally had conversations like that. They're like, you could you could sell it. It's like, who do you think you're buying it from? Like, it's
Gross.
crazy.
Right. Well, they probably imagine some big institution, you know,
Right.
some huge building somewhere.
Some scary bank.
Yeah, yeah. But yeah, a lot of people are probably around your age. They, you know, I coach people, and a lot of 20 somethings come to me and they don't know what they're doing. People oftentimes don't come to me until they already lost a lot of money and they want me to help them get it back. I'm like, well, how about crafting a plan where you slowly make money over time and eventually you might get it back, you know?
Right.
And then they say, but I want it now.
They do. But you know, hey, how smart was I when I was 20? I mean, come on, you know, I was a moron. All right. So, you know, I don't judge anybody who comes to me when they're in their 20s and they don't know what they're doing. Because I've been there. Okay. Thank goodness I've had great mentors, and I have an opportunity through my YouTube channel to mentor people who can't afford lessons from me. They could just watch my videos for free. Got a whole bunch of them. Okay. And some sponsored videos on there as well, just to pay, you know, help pay for the channel. And then, you know, if they want more, they can always contact me, you know, and you know, I do the coaching thing.
Do you charge for that, right, David? Now, if you're comfortable telling how much it is per month or whatever, have at it. If not, they can go look it up themselves.
Well, what I'll do is I'll invite people to go email me, David Modell, Moadel, 1L,
Okay.
at gmail.com. Okay.
Okay.
And we'll talk about it. It's kind of a public service, the YouTube channel I do, because I get emails every day, as I'm sure you do for Options Brew, saying, thank you for telling me, you just saved me from, I was about to do this horrendous thing. I was about to, you know, put it all on red, you know, or whatever, right? I was about to do the roulette wheel trade, and I'm so glad I didn't. And you've probably saved people a lot of heartache, and I'm trying to do the same thing.
Yeah, that's good. I mean, I don't know about that for me, but you know, when I do a lot of demos, so when people they say I start talking, and they say, wait, this guy might know a little more than the average bearer. So they start asking, so what's your background? I said, well, you know, I've kind of been in the business a little bit. Then that's when the questions come. I said, oh, okay.
Exactly.
But that's good. Well, David, thanks for coming on and doing this. We'll wrap it up here. We will definitely promote your YouTube channel, and we'll fire out your email if that's okay, so people can get a hold of you to maybe get a private session. And we'll throw out the Wealth Global, the Crush the Street Investor Place, where they can find some more interesting information on you and what you're writing about and talking about.
Absolutely. Yeah, I write frequently for investorplace.com. You can find me there. I write for TipRanks, TIPRANKS.com, crushthestreet.com, and other publications. You'll find me there very easily.
Yep. We will put it in the finished video with a big banner so people can copy those out.